Good afternoon, students. Today's subject is management accounting. In today's lecture, we're going to learn the entire format of profit and loss account. And this profit and loss account format is as per the Schedule 3 of the Companies Act 2013. This is a vertical format of profit and loss account. And in this, we have two parts, A and B. A part contains continuing operations, B part contains, are you able to see my screen? I've shared. Is it?
Yes, sir.
Okay. So this profit and loss account is divided in two parts. One is continuing operations, then we have discontinuing operations. Now, what do you mean by continuing operations? Students, the business that the company is operating into, that is your continuing operations. But suppose that we have discontinued some of the products, like suppose take example of Garwari wall ropes. Now, if Garwari wall ropes is manufacturing ropes, some harness things, that is their continuing operations. But then in past they were manufacturing, say suppose helmets, or they were manufacturing, say suppose gloves, and now they're not manufacturing. So even though now they are into little bit of sales of that gloves and everything, that is discontinuing operations. So continuing operations are like whatever main business we are into, where we're procuring the raw material, we're converting it to finished goods and selling. From that, whatever money we earn and for which we prepare a profit loss account statement is your continuing operations. In that, the first item, second item contains with your income part as such. So how much of sales you have effected in one financial year starting from 1st April to 31st of March. That gross sales we will take a year for the current year. And comparatively on the next side we'll have for the previous year. So current year is E column, which I'll now highlight as the yellow color. So yellow color column is this year, and the faint blue color column indicates that it was for the previous year. So yellow color is this year's figures, and the blue color indicates previous year. So your first item is revenue from operations. And for that, we have to refer to accounting standard 9 and 10. So as per the guidelines of accounting standard 9 and 10, we have to prepare the first part, that is the income. In income, we have revenue from operations, then we deduct the excess duty that we have collected from the sales, and after deducting excess duty, what you get is a net revenue from operations. So the raw material that you have converted to finished goods and selling, that entire money will be your revenue from operations. Less excess duty than net operations activity. Then we have other income. So in other income, what is there we have to conclude or we have to include in that? In other income, my dear students, we have all the other incomes from the business, which is not our main, what do you say, business. Like, we earn interest, we receive dividend. So that forms a part of your other income. So the dividend we have received on the shares that we have purchased, we invested money, that is your other income. So other income is like the dividend we have received, interest we have received, maybe commission we have received, that forms the other income component. So in the profit loss account, what we have first now just now seen is the first part is your main income revenue, second is your other income. So 1 plus 2, that is total revenue. So how much you have money you have earned by way of sale of goods and other income added up together becomes your total revenue. Now from this total revenue, we are going to deduct the expenses. The first expense is your cost of material. So whatever raw material we have procured in the business for manufacturing purpose, the cost, transport cost paid for the raw material, that will also come to your cost of material consumed. And in that, we will also include the import duty, octroi duty that you paid for the raw material. So whatever raw material you are bringing in the factory, we are going to record in this A part, that is cost of material consumed. So it will be opening stock plus purchase plus carriage inward plus octroi plus import duty less closing stock of material or less the material that we have returned back to the suppliers. So that is your first component, that is cost of material consumed. Second, then we have purchase stocking trade. So there are the chances that we are directly going to buy some bought out item which we are going to directly utilize in our production facility or directly going to sell. That comes under purchase of stocking trade. Then most important, then we have is changes in inventories of finished goods working progress stocking trade. So what is the C part contents is like previous year you had some finished goods in your business. We're going to take that. We're going to add the new material that we have manufactured, and then we're going to deduct the closing stock. So that is your changes in inventories of finished goods or WFP or stocking trade. So whatever goods already we have finished goods last year, we're going to consider that. In that, we're going to add the new finished goods we have manufactured minus the finished goods stock. That will be your changes in inventory finished goods. So that is your third item in expenses. The fourth one is employee benefit expenses. So the fourth title, employee benefit expenses, means what? So this for employee benefit expenses for the term called as employee. So who all are will be treated as employee for this accounting purpose? So the workers who are working in the organization are employees. The staff who is working in the organization is again a employees as per the income tax rules and everything. Besides this, the directors who are full-time directors who are working in the organization who are taking salary will also be your employee benefit expenses. So in short, whatever amount you're paying to employees by way of wages, by way of salary, by way of bonus, by way of provident fund, by way of meeting fees, the directors attending, that all will come in the category or this head, that is employee benefit expenses. Then we have finance cost. What is finance cost? Tarun, any idea what is finance cost? Atul? Yes, students, any idea about finance cost? Employee benefit cost? If you know, say yes. If you don't know, say sorry, sir. We don't know. Please
Sir,
explain. Yeah, tell me.
the cost, the cost which is held for management accounting.
Yeah, finance cost. Yes, Tarunum, I appreciate the efforts you've taken to answer. Yes, Tarunum, you have any idea about this? Finance cost? Yes, tell me fast. Satvinder?
No, sir.
No, okay. So be bold, okay? Learn to say no, learn to say yes also. So let me explain in that case, what is finance cost? See students, when we are operating a business, we require capital. And then not that the entire money can be arranged by the promoter or the director. There may be a need that we have to procure finance from the market. Like we have to borrow funds from the market. So when you're borrowing money by way of issue of debentures, or you're borrowing money by taking loans from the bank, secured loans, unsecured loans. So whatever amount we pay towards this is your finance cost. So whatever finance you've taken in the business for which we have to pay the cost is called finance cost. So if you issued debentures and collected capital, that debenture interest is your finance cost. Then you're taking a loan, then you have to pay monthly interest to the bank, that is finance cost. So finance cost is the amount we pay for procuring the finance on borrowed basis. That is the finance cost. Understood, students?
Yes, sir.
Example, tell me.
Yes, sir.
Yes, very good. What is the next part then? What's the next heading?
Depreciation and amortization expense.
Yes. So in business, what is depreciation? I did not explain you, but still I will explain you. It's my duty. So depreciation is the gradual reduction in the value of fixed assets. Depreciation happens because of the wear and tear of the fixed equipment. It also sometimes happens that you're not utilized, but because of passage of time, the amount of the asset goes down. So the amount that reduces the value of fixed asset is called as depreciation. And every year or maybe a certain period of time, maybe 5 years, 6 years, the amount is deducted from the value of asset. So depreciation, come again, is the gradual reduction in the value of asset. Depreciation is a gradual reduction in the value of asset. Umesh, you're disturbing my class. Yes. So that we have understood what is depreciation. Let me come again. There was a disturbance. Depreciation is a gradual reduction in the value of asset due to wear and tear or passage of time. So whatever assets we have in the business and whatever amount we're deducting will be depreciation that will be taken care in the expenses F column. And then what is amortization expenses? Suppose that there is a concept of deferred revenue expenditure. So what is deferred revenue expenditure? Example, that you spend a lot of money on a big advertisement Okay, and that amount of advertisements may be somewhere around crores of rupees. And because the amount is such a huge, like we have maybe constructed a hoarding or we have paid a lot of amount for hoarding advertisements. So these are advertisements which will create an impact for not 1 year, more than 1 year. And that huge expenses, heavy expenses has to be split into 3, 4, 5 years. And that splitting of a big amount or big expenses into 4, 5 years is called as amortization. So any deferred revenue expenditure, when every year we are going to amortize the amount, that will come under this expenses of F category, that is depreciation and amortization expenses. Yes, next one. Yes, please.
Other expenses.
Other expenses could be your admin expenses, conveyance, telephone bill, uh, office rent, repairs to equipments, bad debts, discount allowed, advertisement, carriage outward. So these are examples of other expenses. Let me come again. This is very important. Students, we are learning the format of profit and loss account. In profit and loss account, there one item is your continuing operations A, and then we have discontinuing. Now in this, there are total 4 items: 1, 2, 3, 4. And 1 and 2 is focusing on the income that we have earned in the business for one financial year. Third item, total revenue, is the addition of the main revenue plus the other income that we earn in the business. So the first item that we had discussed was revenue from operations. What is revenue from operations? Whatever sales we have affected, this sales could be cash or credit. Both taken together forms the part of revenue from operations. In that, we have sold goods to customers and we have added any excess duty. Then you have to deduct the excess duty from the sales amount, and then what remains is your first item. What is that? Revenue from operations, and the figure is net figure. Then we have second item in the income is other income. So in the other income, I had already told you what comes in the other income is your dividend we have received on the investments we have done. We have received interest on any investments. We have received any commission. This forms a part of your other income. So other income is what? The dividend that we receive, the interest that we receive, the commission that we receive in the business in one accounting year is your other income. So this total revenue is what? Addition of first plus second is equal to total revenue. Suppose your income from operations is 10 lakhs 80,000, example, of which 80,000 is your excess duty. That means your revenue from operations is how much? 10 lakhs. Okay. And you received the dividend and everything like 2,50,000. So your total income is then 12 lakhs 50,000. Understood? Yes or no, students? Taranum, are you getting me? Are you with me?
Yes, sir. Yes, sir.
Fine. So
Yes, sir.
our gross sales is 10 lakhs 80,000, of which 80,000 is excess duty. So when we are calculating income, we have to exclude the excess duty or GST that we have paid. So your net sales is 1 lakh rupees, 10 lakh rupees, sorry. And in that 10 lakhs, we have earned, maybe we have earned commission, dividend, or interest. That is amount is 2,50,000. So total income stands to 12,50,000. Now from this income or revenue, we have to deduct the expenses for which we are running the business. So the first expense is cost of material. What is cost of material? Cost of material consumed is the amount that we have paid for raw material. So it is a raw material, transport of raw material, that is carriage or carriage inward or freight charges. In that, we're going to add up octroi, we're going to add up customs duty, we're going to add up import duty, we're going to add up loading charges, if any. In that, we're going to reduce or deduct. What is that we're going to reduce or deduct? We're going to reduce or deduct something that we focus is, what is that? We are going to reduce the material that we have sent back to supplier that is not of good quality. That we deducted. And from that, we'll deduct the closing stock. So cost of material consumed is in one financial year, starting on 1st of April until 31st of March, how much is the accurate amount of raw material we have consumed will be taken care of. We will not consider the closing stock. So opening plus purchase minus closing stock is equal to your cost of material consumed. In this cost of material consumed, what are that all we're going to add up is raw material, carriage inward, freight charges, unloading charges, opera duty, import duty, customs duty, if we are importing the butter from other country. Now then we have second part as purchase of stock in trade. So there are some stuff that we are directly buying and directly selling. So if you are directly buying and selling without making any alterations, changes, upgradations, that item becomes your purchase stock in trade. Whatever amount you have paid in a 1 year financial year for the material that you without alteration you're selling, that is your purchase stock in trade. Then this third expenses in the profit and loss account is titled as changes in inventories of finished goods or working progress and stock in trade. So what is changes in inventories of finished goods? So changes in inventories of finished goods is what? That we have last year closing stock of finished goods. In that, whatever we have produced, final goods from 1st April 31st of March, that will be added in your finished goods. And in that, we're going to deduct the closing stock of finished goods. That is your changes in inventory. Okay, I'll show it again, little down. Yeah, it is this way, my dear students. That is first is opening stock of goods, opening stock of finished goods. Then we are going to add up the new, whatever we have manufactured in this year, add manufactured goods, manufactured finished goods during this year, and then less unsold goods or closing stock. Suppose that we had initially finished goods worth suppose 25,000 example. In the year we have manufactured 7 lakhs of goods, but at the end of the year we have 30,000 what unsold. So your changes in inventory for finished goods would be how much? 7,25,000 minus 30,000, that is 6,95,000 is the changes in inventory of for finished goods. Tarunum, Atul, Satpinder, did you understood this? How it is calculated? Opening stock plus additions or manufactured finished goods during the year, less unsold goods at the end of the year. This is opening stock at the opening, at the beginning. And closing stock at the end of the year. So what remains is changes in inventory for finished goods. I hope you understood this very well. Tarunam, Satvinder? Yes or no?
Yes, sir.
Very
Yes, sir.
So this is how we'll calculate the material we have consumed or we have. Okay, then okay, now we have finished the revision for stock in trade, change in inventory. Now then what is it? We have D part. Tell me, title. Students, tell me.
Employee
Employee
benefits
benefit.
expense.
So when an employee is working in an organization and whatever benefit he gets in terms of rupees, cash, that will be taken as employee benefit expenses. So what are the examples of employee benefit expenses? The worker is working in your factory and for which we are paying wages. So wages is one component of employee benefit expenses. The employee who are working in the office, they get salary. So salary is a second component under employee benefit expenses. So besides this, if your company is giving bonus to them at the every year, that will be added in your employee benefit expenses. So employee benefit expenses is like wages, salaries, bonus, provident fund contribution, gratuity. So any amount of benefit the employee gets from the business is will be taken as employee benefit expenses. Now, when there are some directors who are full-time working in the organization, when the directors are full-time workers or full-time directors, they get salary for that. They are paid a lot of things like they're paid mobile bill or anything. So that will be also coming under the employee benefit expenses. So employee benefit expense is what? The amount paid to employee as an employee during a financial year is called as employee benefit expenses. And the examples are wages, salaries, bonus, commission, provident fund, gratuity, This all will fall in the category heading of employee benefit expenses. Yes, what is the next one, students?
Finance cost.
Fine.
Yes, what is finance cost? The cost that we have paid for procuring the finance from the market is finance cost. So what is that we have to pay? So we have to pay interest on the debentures if we have taken debentures. If we've issued the debentures and against issue of debentures, we have raised capital. So the debentures we have to pay interest maybe every month or every 6 months or yearly. So the interest paid on debentures is finance cost. Once again. Then second is that we have is suppose that we have borrowed money from a bank by taking a term loan, then we have to pay the interest to them. So interest on debentures, interest on bank loan is comes under the category of finance cost. Now that you have paid, you applied for a loan and you have to pay the loan processing fee, that also comes under finance cost. And to some extent, sometimes this bad debts is also taken as fixed cost. Sorry, the audit fees is also considered as the finance cost. The audit fees, interest on loan comes under the category or heading of finance cost. Next one. What is the next one? Tarannum, Satvinder?
Depreciation and amortization expenses.
Yes. Can you tell me what is depreciation now? Tell me what is depreciation? Any rough idea?
The decrease in value of fixed asset due to wear and tear.
Very good. It's called a depreciation. So now this amounts, how it will come. So let me give in this thing. So employee benefit expenses 25 number. So we have a schedule number 25 at the end of the entire profit loss account. So here, note number 25. The heading is employee benefit expenses. In that, we are paying wages, we are paying salaries, we are paying bonus. So if I paid wages, suppose 25,000. If I paid salaries, once again, we are paying salaries, suppose 50,000. We are paying bonus, suppose 10,000. So this entire amount, if you calculate, is 85,000. So this 85,000, my dear students, this note number 25, 85,000 amount will reflect here in your profit loss account. Atul, can you switch off your camera? Don't show that you're sleeping and attending lecture. So employee paid expenses, what we had total was here. Atul has a bit of disturbance. How much is the figure? 85,000. So this 85,000 will reflect here in the employee benefit cost. So this is how this profit loss account has to be prepared. So after this, we have to prepare notes 24A, 24, 24BC. So 25 will have a note here 25. Finance cost same. So we'll add up, suppose we have paid interest of 15,000. Depreciation, suppose 2,500. Depreciation, suppose 2,500. Then other expenses, like I spoke to you, conveyance, telephone bill, then we have discount, bad debts, carriage outward, go down rent, factory rent, office rent, and then we have advertisements. This falls under the category of other expenses. So we will take this, suppose the bottle consumed is, we suppose say 5 lakh rupees, 50,000. Stock in trade, suppose 25,000. Changes in inventory, suppose 13,000. So this all expenses will be added up. So all expenses when we add, it is 2,55,000. So 2,05,500. What is the total income? 12,50,000. So you have to deduct this 2,00,000 expenses from your income, and what you get is your profit or loss before exceptional items. So this amount will come from 12 lakh 50 minus 2 lakh 5,000. So it would be around 9 lakhs 99,000, 9 lakhs 94,500 approximately. So this is how you prepare the profit loss account as per the schedule 13 given. So first two part is income and the next part, fourth one is your expenses. We add up that and we deduct, we'll get the profit. I hope you understood this very well, students. Hello.
Yes, sir.
Yes, sir.
Okay. So I will not, what do you say? I will not conduct the class further now because I want you to understand this very well. So now after this class, you have to go through YouTube and find out the format of profit loss account. Write it down in your notebook. You have to buy it all this. You have to memorize this sequence 1, 2, 3, 4. You have to this sequence also has to be maintained. Cost of you can't interchange the sequence of this because this is the format given by the Schedule 3 of Companies Act. So you have to please practice this. Okay. For now, I'll stop the lecture. You please write it down. Fine. Taranum Satvinder.
Yes, sir.
Thank you. Bye bye. Write down the format of profit loss account in notebook. Okay. And send me on my WhatsApp.